we know that the tariff news has caused an epic market meltdown. In the last video, we explained the theory that these tariffs were all part of a master plan to send investors out of equities into U.S. treasuries and bring borrowing costs for the United States government down. So if rates are falling, isn't that great for companies, especially companies with a lot of debt? No. What's good for the U.S. government is not necessarily good for companies. First of all, the U.S. government can literally print money, so the perceived risk of default is essentially zero. Companies, however, not so much. When we think about the components that make up the interest rate that a company borrows at, you basically have some base rate, like what is the yield on U.S. treasuries or SOFR, plus a credit spread. And I want to harp on that second part because the credit spread compensates investors for the risk of default, meaning what is the risk that the company is not going to be able to make their interest payments. The riskier the company is perceived to be, the higher that credit spread. Just a simple example. If treasury yields are 4% and the credit spread is 150 basis points or 1.5%, that would mean the all-in total borrowing cost is 4% plus 1.5% or 5.5%. However, with these new tariffs, that spread is widening. So it's not 150 basis points anymore, it's going to go up. Now, why is the default risk rising? Number one, higher potential input cost, as tariffs basically mean that raw materials cost more. The company can therefore eat the cost or potentially pass some of that higher cost onto consumers. Now, that would mean there's then less people that are willing to buy because the price has gone up, which is compounded by the fact that internationally there's these additional tariffs that are being hit on exports, which is also going to potentially limit the demand abroad. Now, the final piece is debt covenants. So for example, you might have a covenant that says you can't go over 6 times leverage. Now, leverage is just calculated as total debt over EBITDA, where EBITDA is a rough measure of a company's earnings. So if a company has $400 million in debt and $100 million of EBITDA, they would have leverage of 4 times, right? 400 over 100. And again, if a debt covenant says that you can't go above 6 times, you're good. However, if profits fall to say $50 million because of the impact of these tariffs, now all of a sudden your leverage has gone up, right? So 400 over 50 is now 8. So now you've violated a covenant even though you haven't borrowed a dime more. And on top of that, now your perceived risk is higher, which means that again, your credit spread should go up. So the interest rate that you're paying should go up. So the point here is that while falling rates might help the U.S. government, that doesn't necessarily mean that companies with debt are in good shape.